Hey guys, how's it going? This is Derek Craig with another oilfieldbasics.com Discover podcast. Thank you for joining me. Today we're going to be talking about production curtailment and shut-ins. So, we've done previous episodes talking about what was going on with the prices and kind of what to expect. We've had some longer-term outlooks on the prices. So we've had a history of kind of episodes leading up to this, and companies have really been going through a lot of decisions lately in terms of, should they shut in, at what point should they shut in, and kind of what are the challenges with shutting in. So we're going to be talking about that today. I've got Jon Clark with me here. I'll be introducing in just a moment. So we're going to be diving into that topic and lots to talk about there. So definitely pretty interested and excited to dive into that topic. Before we get there, though, just want to do a quick announcement. Something I haven't announced yet is a new course that we've released. It's a case study. It's actually talking about friction reducers, and it's optimizing the performance of friction reducers with the use of produced water. I can't talk evidently today. With produced water for hydraulic fracturing. So actually, the lady who authored that is Tania Galindo. She's actually been on the podcast before. She's got another course up on our website also. So definitely check that out. It's a pretty good resource, and she dives into a couple of different case studies, and it's about an hour long. So pretty easy to go through, and hopefully a pretty useful resource for any of you guys who are in completions or even in the produced water business, so handling or treatment or anything like that. So definitely pretty insightful. Check it out. Like I said, just haven't mentioned it yet at this point. At this point, it should have been out for a little bit, but didn't get around to announcing it yet until this episode. But definitely check that out, and always be sure to follow us on our LinkedIn and on other social media channels, and check out our website. Periodically writing content rather frequently now. So with that in mind, I don't want to stall around too much. We'll definitely start diving into the topic here. We got a lot to talk about and a lot to cover. Like I said, we're going to be talking about production curtailment and shutting in production. So with me today is Jon Clark of Clark Energy Consulting. He's actually owner of the consulting group there. He's currently going for his MBA and has experience working with a handful of different large E&Ps, and so he's pretty familiar with all the other fire drills that they might be doing in moments like this. So I'm pretty excited to have you on today, Jon. How you doing?
Hey, Derek, doing well. How are you?
Pretty great. We've been wanting to do a collaboration for a while, man, so I'm glad we finally got around to it.
That's right. It's been a year or more, I think. So glad to be here with you.
Yeah, for sure. But yeah, well, tell us a little bit about your background and what you do with starting your own consulting company. That's pretty impressive. I know you guys kind of dabble in a handful of different areas. So tell us about that.
Yeah, Derek. So I've been working in oil and gas since 2008, and had the chance to work for a handful of different prominent producers, ranging from big to small, and really in the area of operations, execution, and development strategies for shale fields. And so I'll talk a little bit about that. I recently started my own consultancy, Clark Energy Consulting. You can visit us on the web at www.clarkenergyconsulting.com. And the reason I started the company was I found that there was really a need for a lot of the information that was learned during the growth time of the shale revolution, and also during the contraction period, and everything from oil field services to upstream E&P strategy, industrial services, and generally just market strategies and ways to help improve oil company profitability, and also on the service side. And so I speak with investment management professionals and professional services companies, other industry companies that really just have a need to kind of put the pieces together of the intricate oil and gas dynamics. And so, some of the things that we did during the boom time, was really growth at all costs, and, developing fields and strategizing how to develop those fields. But a lot of that changed in 2014, 15, obviously, when oil prices dropped from the hundreds to the 30s.
Yeah. And just a little bit changed.
just a little bit. I was actually at Anadarko Petroleum at that time. Before that I was with ConocoPhillips, and I was brought on with Anadarko to actually develop a new field. We had about 3 wells that were drilled and completed, and we had a budget to deliver 50 wells. And a lot of what we did was just trying to decide, what are optimum designs, how can we space out wells? How can we develop the field, economically? And then when the price crash happened, we had to obviously cut costs pretty quickly. And a lot of those was renegotiations, not as well as just fundamental changes in the design and decisions that were made. And that was mostly on the completion side. And so, and then I also had a chance to work for Carrizo Oil and Gas, where we were kind of in a late field development. So I've really seen, early and late field development strategies. And then, fast forward to today, and even just 5 weeks ago when oil prices went negative, obviously the rig count and frac crew counts have dropped. That's really the first thing that gets cut. Obviously, the high capital spend categories, but even production curtailment and shut-ins, and ultimately, there's a break-even cost and a lifting and operating expense that is uneconomic at sub $20 a barrel, or even below 30 or 40 in some cases. So kind of looking at what I think are the considerations for cost control today, are really more around the production, and I think what we can talk about is some of the considerations for decisions, because it's a really complex dynamic, and there's a lot of factors that need to be considered, just even aside from economics. And so happy to kind of go through some of those with you, Derek.
Yeah, for sure. No, definitely. Very cool background, and it's kind of your timing. Every time I've talked to you, your timing has always been interesting in the sense of like when you got in, you got to see kind of the 2015 kind of era bust, and then how people how companies responded then, and then and been on the different sides of development strategies, and like you said, like new fields and even existing fields. So you definitely got to see a good bit in just so many years that you've been in the industry. So pretty cool background.
Thanks, man.
What do you think is kind of I guess kind of start off some of the biggest differences here between like what we saw in 2015 kind of era, that bust, and so shales were spooling up, and that's kind of the first big hit, I think, to the gut, to the shale fields. And then so obviously, and then this round, as you kind of hit on before, it sounded like a lot of the adjustments were kind of slowed down, but a lot of the adjustments were done, with designs. And does this 2020 downturn feel different in the sense of how hard it's hit, or even the options companies have to react just on a real high level?
Yeah, I mean, the low-hanging fruit has already been picked, so it's definitely a tougher environment to navigate. Also, a lot of the service companies have really scraped the bottom of the barrel as to what the prices that they can offer. So it's really a fundamental shift. I think what makes it different about 2015 and is that we're still learning a lot, and I think there's still a lot of efficiencies opportunities. At least from a drilling and completion standpoint. Today, we've already kind of maximized those, and so the last opportunity to do to make a change is to control the valve of the well, in such a low price environment. And there's other things that can be done. We'll talk a little bit about that, but really the question is it appropriate if your break even costs are above current price to curtail production or completely shut in the well? And that's going to vary across businesses and different business models, business company sizes. If you were to think of a small company that may only have 10 or 20 or maybe 100 wells, 100's still pretty big, but a handful of wells, and they're probably going to be more inclined to just shut in the wells and wait for price to come back and open them back up. On the contrary, larger companies that have future development plans that may have risks of drainage of offset neighbors' wells, competitive neighbors, and then also ultimately what is their break even, and the larger companies typically have more scale, and their break even costs are typically lower. And so if you think of a bigger company, you could make the case for more of a curtailment scenario versus a full shut in. And so obviously that's going to depend on the reservoir and the geology, which plays. If you think about the Permian Basin, there's still a bit more development opportunities there compared to Eagle Ford and Bakken. So I think in the Permian you may be more likely to see a curtailment, or at least a curtailment in regions where you may want to still have, you don't want to impact the reservoir pressure, or a full shut-in if you want to plan to drill a well next door, to maintain the reservoir pressure. So your future development plans obviously will impact the decision to, either curtail or shut in. And considering reservoir pressure, obviously that's the main reservoir drive mechanism. And then, second to that, the reservoir fluid type, and how does that impact production? And so, you may have a different strategy in a black oil reservoir versus a volatile oil or a condensate gas. What is the artificial lift type? Obviously rod lift and isn't, not does not function as well in a gas environment. And so, if you can actually curtail production so that you maintain a reservoir pressure above the bubble point pressure, then that's something to consider as well. So there's a lot of factors that go into it. We're just touching the tip of the iceberg here.
Yeah, no, definitely. And I think we're kind of just to backtrack too, and then we can dive into some of the specifics that you were just talking about too. But in terms of, one of the things you mentioned was low hanging fruit has already been picked. And, just from what I can remember too, so I came into school in 2015. So I just caught when we were kind of stepping into that little burst there with the industry. But one of the things that was the big changes there, was the drop of break evens. So previously, like, everybody's used to $100 oil, or pretty high, and so they'd have break evens, $60 to $100 even a barrel, just some crazy break evens. And then now we've got pretty comfortable with a break even environment, $40 to $60, and now that's definitely been pushing the threshold. So I think whenever you talk about low hanging fruit being picked, I think that is mostly what you were kind of referring to there, right?
Yeah, definitely. And I remember when we had break evens and, $60 a barrel, and in the 15 crash, we were down below that. So that's really where we had to make those changes. And I think, to put it in perspective, the shale industry has, become competitive with offshore as far as break evens. I think offshore, Gulf of Mexico break evens, maybe somewhere around 35-ish, 40. And so, there's space in the Permian that are at that point too. So it's a testament to the innovation and, the technologies and the learning curves that, in the real, focus on, reducing costs and reducing those break evens. So, but that also is, kind of where we stand today, where it's like, there's not much room to do more, to reduce that. So it's going to take, additional measures.
Yeah. And we've seen some companies even lower it a little bit right now too, but you get down so far, it's like, how much further can you, it's like the limbo, right? You can only kind of go so far before it's just not worth it. And I guess kind of just another big picture question here to throw at you, because I think this is definitely something worth bringing up. I've seen people kind of asking these types of questions even on like social media. Fundamentally, why would it make sense for a company even to shut off their only source of revenue, right? So it's like the only way we make money. I've got an answer, but I wanted to hear your take on it too, just to help people understand why this is happening. So like, even if it's $10, like, why is $10 still not better than nothing, right? If we shut in the well. So what would your answer be to that?
Yeah, I mean, obviously, anyone that's in the oil and gas industry knows that it's a volatile one. And so, the cure for low prices is low prices. And I was actually pretty surprised to see how quickly oil prices have rebounded in the 30s. We were at 35 today. And so, if you can plan for a shut-in and, defer your production till price is better, you can, your revenue increases. So it's just a deferment of revenue.
Yeah. And the other thing I'll add to that too is it's not just what you see at WTI at or whatever. That's what we're getting. We definitely have a cost associated to producing that. So a lot of, especially if you look at areas like the Permian and stuff, like the infrastructure cost and everything is pretty high. And depending on the company, depending on what all they have access to, what their midstream, what all their agreements and everything looks like. But even if you just think about taking care of water production in some of these basins, you might get a barrel of oil, you might get 1 or 2 barrels of water. It's that bad in some areas, I'm sure you can attest to. And there's definitely a cost associated with producing that 1 barrel. And, for an artificial lift, the cost of running that and the facilities and everything like that. So the idea is, if you can shut in some of these things, then you can basically eliminate or reduce those costs, associated with the production, or like even some of your fixed costs, like with your facilities and whatnot. But yeah, anything you want to add to that, just kind of a high level?
Yeah, no, that's, the fixed cost is a huge consideration. And really that the biggest fixed costs are labor, power, water, and any other G&A costs. So those are you're still gonna have to pay the rent, you're still gonna have to pay the people, or unfortunately we've seen quite a bit of layoffs that, that's just going to happen. But I think if you can, at least hold on to some people and renegotiate with your water providers and power providers for artificial lift, then it would make sense to shut in, wait for prices to come back, and you may get a benefit of flush production when prices are higher, and so you can actually accelerate revenue, with higher flush volumes at a higher price.
Yeah, no, definitely. That's an interesting concept. Also, another thing I wanted to kind of ask you about, you mentioned it a few minutes ago, was about the larger companies sometimes having a higher break-even cost. So you would, one might think that being a larger company, maybe you have a lot more research, and you just know how to operate better in a sense. But that's kind of opposite of what we see, or in terms of cost. And they might have more research, they might have all that. There's costs associated with getting all that, and what typically the larger workforce. I mean, what contributes, would you say, to the larger companies having a higher break even, so being harder to produce during these times?
Yeah, I mean, the contributing factors to a higher break even are probably the first, driver I would say was the reservoir. I think that's a bigger driver than a lot of the costs and the fixed costs. So I mean that's number one. I think secondary would be the G&A costs, and like I mentioned, those fixed costs. So really the break evens are a function of reservoir, fluid type and reservoir pressures that obviously contribute to flow, and that's number one. But then the secondary would be more of the cost components. When you just look at a well that's already producing, the lifting and operating expenses associated with that, it's more heavily driven by the reservoir than those other factors. But certainly, the other factors make a significant contribution and can really impact the break evens, just like how the industry was able to reduce those in the last downturn.
Okay, gotcha. And so I guess so they pretty much got 3 options, right? They can keep on chugging and maybe lose money, maybe not, but operations, everything kind of stays the same and less of a headache in a sense, or they can selectively cut back wells, or even kind of cut them all back to a certain targeted rate or something, which maybe they will maintain some of their obligations and whatnot, keep their facilities up and running, so they don't have to deal with all the heartaches of shutting down and restarting equipment, or just a full shut-in, right? So I guess anything you would add to that, and then how do you see companies kind of beginning to navigate to pick one of those 3 cases in a sense?
Right. Yeah. You bring up a good point that I didn't mention, was the contractual obligations or minimum volume. It's there's a lot of leases that require, in order to hold the lease to continue to produce or drill, you have to produce in economic quantities. Sometimes that's a clause in those leases, and so and you'd probably need to ask a lawyer what that means as far as economic, but I think it's just producing any money. But if it's positive cash flow, that's a different story. So that's one thing. And, I think that, that if you have a lease with that type of clause and you plan to drill later there, you may just curtail instead of fully shut in, so that you don't lose the lease. And so that's a very, that may be step number one, or the first action, or first thing to look at if you do have, a production clause in your lease. Other than that, I think it's a mixed bag, and it's going to vary between companies. And at the end of this, we'll look back and probably learn a lot more about what operators have done and how they've managed this. Mm-hmm. It's still, something that really kind of depends on each individual company and what their situation is. Obviously, if there's debt covenants upcoming or anything financially related that would require them to continue to produce, that is obviously, part of the business model. That's fundamentally, that's a easy decision to make because there may be covenants with the investors that state you have to return some type of cash flow, and then that's the case, then you'd have to continue producing. But if it's like a portion, the curtailment could still be an option. But the other thing to consider is, and this is heavily debated, and I've thought about this quite a bit, is the impact on the reservoir, by either fully shutting in or curtailing the production.
Mm-hmm.
And that's going to vary, I think, between assets and vintage of the asset. So, and a lot of it has to do with really just the reservoir drive mechanism and the reservoir fluid type, and the vintage, as in, what was the frac intensity that was put on the well, and what is the potential for damaging the reservoir. Typically, the older fields are going to have a lower reservoir pressure. If you were to curtail it, it may not do much, but you could, and this is where timing the price swings could be beneficial for an older field. You could shut it in, let the reservoir pressure build up, wait for prices to be higher, and then open it back up. And I think that's prudent. That would be a great strategy in the Eagle Ford, especially where they're in the condensate window, where there is gas solution drive as a mechanism. And, being able to, like I mentioned, bring the bubble point pressure above, or the reservoir pressure above the bubble point. And for those that don't know, the bubble point pressure is the point at which the gas comes out of solution in the reservoir. And if you think of like a soda bottle, open a Coke bottle and, bubbles coming to the surface, that's kind of the same idea. But you don't want that, that naturally happens as you produce through the tubing of a well as the pressure drop occurs. But you don't want that to happen in the reservoir, because then you're leaving oil behind. And so recovery factor is what we call that. And when we look at how much oil can we extract out of the reservoir, out of the total, and recovery factors for shale wells are like 5%, maybe 10%. They're super low. And it's, it's even the best wells leave oil behind, especially the condensate section, reservoirs. But being able to shut in the well, let that pressure rise above bubble point, and use that gas to flow the oil to surface is a huge benefit. And I think, in those scenarios, a shut-in is probably the best solution. But if you're talking about a black oil reservoir, like in the Bakken, for example, you don't have gas as a drive mechanism. So, and you may actually have more water production to deal with. And so you mentioned about water handling, and especially in the Permian. I think the Eagle Ford is about 1-to-1 water to oil ratio. The Permian is at least 2 or 3-to-1. I've heard 5-to-1. I've heard some people say 10-to-1. So the water, managing the water, is going to be something to consider too. That's where I think renegotiating with water vendors is, one solution to work on that. And I think I've heard that, in the U.S., we've already experienced 2 million barrels per day reductions in supply. So that's about 20%. It'll be interesting to see if that continues to fall, or if people start opening wells back up now that we're, at $30 to $40 range.
Yeah. And it'll be interesting to see, like, where the biggest production cuts have come from, whenever we start actually getting the state reporting on that. And it'll be interesting to see kind of what everybody's philosophies were and how they chose, their assets and whatnot. But you bring up a lot of interesting points in terms of, just getting people to understand, even some of the complex little pieces of this, when it comes to even just the reservoir, and understanding like what you're dealing with, and what, it's not going to be the same answer for every well in your asset. And that's one of the things that really frustrated me whenever some people kind of saw it coming, the negative prices, and just saw us heading into this. And even at the beginning and even through it, some people were just like, operators are going to have to shut in to survive, operations, and like just a blanket, like everybody's going to have to shut in kind of statement. And that's not at all very, there's a lot of things missing in that.
Right. And, the other thing we didn't talk about yet is the midstream component and the marketing component. And a lot of the smaller producers, and I had a chance to listen to the Railroad Commission. They met with a lot of industry companies and CEOs and think tanks talking about should the state of Texas mandate production cuts, and ultimately they decided against it. Oklahoma did the same thing, and so ultimately saying we're going to let supply and demand dictate that. But what I heard when I listened to some of those, the smaller company CEOs talk is like they only had a handful of wells, and the midstream companies were not honoring their contracts. And what I realized was that a lot of the smaller producers typically only have 1 month contracts, so they're not securing long-term contracts to
with
sell
the
their
midstream
product.
Oh, okay.
Right. So the midstream companies would not even take their oil because they were more focused on the bigger companies that had more volume commitments and longer term commitments. And so that is another huge factor. I think, that's another reason why I mentioned a lot of the smaller companies are probably more likely to fully shut in these wells, which is unfortunate because the small independent producers of America are the ones really hurting the most. But a lot of them are producing conventional assets that have been producing, stripper wells, a few barrels or maybe a barrel per day for years. It's really low volume, but that's really just passive income for a lot of people. So, that's a totally different business model than when we think about, the major public companies that have these long-term contracts, and even the vertically integrated companies that own midstream and downstream assets that can, secure those longer-term contracts. And then, the other thing to consider is the price differential. And so the price differential obviously is, what the drivers that impact that are proximity to the market. And pipeline availability, and then the API gravity of the crude. And so the refineries have been flooded with sweet crude, West Texas Intermediate, and they're actually having trouble finding sour heavy crudes right now because they need both of those to blend. And so there's actually a premium for heavy sour crude right now, and that's typically not been the case. Before the shale revolution, there was a premium for sweet West Texas Intermediate, and heavy sour crude was not really wanted because we had more of it. And until we unlocked the shales and all of that sweet light crude, now we have an abundance of it, so that it's kind of shifted. And so there's
that crude from the sour kind of heavier crude.
So there's a really good resource for any of the listeners that want to check it out. S&P Global Platts has a periodic table of the different API gravities and crude types, and it will tell you like which regions they come from. I know that like Venezuela has a lot of sour heavy. I know Canadian crude is heavy. I'm not certain if it's sour, but a lot of the Middle East production is certainly sour, and some of it's heavy as well. And so I'm not as familiar on the downstream side. I'll be honest,
but most of it's international, it sounds like.
Right.
Okay. Interesting. Yeah, I didn't know that swing was happening there. That's interesting for sure. So one of the the other things I want to and you've hit on is considering the artificial lift type and how that factors into it. Could you just kind of elaborate on that, or maybe give some examples as to how that might play into the consideration of shut in or not?
Right. So there's four main artificial lift types. You have obviously rod lift, ESP, gas lift, and plunger lift. And some operators have even used a combination of gas lift with plunger lift. Ultimately, the selection criteria for those lift types is volume dependent. So rod lift and ESP can handle more volume, which is great for places like the Permian, especially where there's a lot of water. The problem is ESPs can't handle sand very well or debris, and they can tend to overheat. The good thing is the Permian is typically low temperature, but I typically don't see many ESPs ran in shale wells just because there is a lot of sand flow back that can occur. But it can handle more volume than rod lift. Rod lift can still handle quite a bit of volume, but the only downside is it does not handle gas very, very well. And the reason is because it can cavitate the pump, which is downhole, basically meaning that when gas enters that, as the piston strokes, that gas, is forced, and it creates like a force that breaks or can break the downhole pump. And so,
Or just
as
gas
you
lock
produce
it.
the well,
Yeah.
if there is gas lock. And so as you produce the well, there's typically more gas that gets produced. And so that's something to consider. And I don't know if, I think one of the benefits of rod lift and ESP is that you can control um, the number of cycles that it strokes. And so by doing so, you can curtail the production. It doesn't have to be a full shut in. That's one of the benefits.
Mm-hmm.
ESP is typically on like a variable frequency drive motor, so you can adjust that too. The other lift types are, and then if you have a gas pipeline in place, you can use gas lift to recycle your field gas. But
Mm-hmm.
if you were to think about the Permian, artificial lift types are predominantly rod lift. And so what I suspect is happening, and I don't know, and we'll probably learn more later, is that just controlling the number of strokes that the horse pump is pulling can, in essence, curtail the production.
Mm-hmm. Yeah, and I'm
It's
sure
not,
companies.
but
Go ahead.
sorry, I was gonna say, earlier I mentioned the idea of just controlling the valve. Well, the the rod lift is its own controller too,
Mm-hmm.
so it's not necessarily
Yeah,
just
definitely a little bit of a figure of
closing.
speech there.
Yeah.
And there's actually a guy, I saw on a Facebook group, like asking like, okay, how do you shut in a well? Like, like, well, it depends.
Yeah.
Definitely going to depend on the different, whatever artificial lift type and whatever procedures the company has in place. But, and I'm sure, along the lines of, how artificial lift plays into it and the different types, it's going to be, which types cost more to operate, and would be riskier to shut off or whatever. So like you talked about, with if you shut in a well for sometimes maybe you get some solids to build up downhole when it may or may not be an issue, or a variety of different issues can occur. So there's definitely a lot of considerations within that realm to pay attention to also. And of course, all this factors up into startup difficulties, and like whether or not it's going to be easy to, if you do fully shut down a well, or if you just kind of curtail it, it's probably, if like you talked about slowing down the pump jack, it's probably going to be a whole lot easier to deal with in terms of ramping it back up. But if you're actually shutting down a facility or a well, actually hard shutting them in, it's definitely going to have its own set of potential costs and challenges whenever you go to start it back up.
Right. And facility maintenance is a big part of that. And depending on how the facility is configured, if it's centralized or if it's a single facility on a single well site, that can play a factor into it. It'll be interesting to see if any operators choose to take a shut-in opportunity to perform a well test or a workover. I don't think that'll be the case because nobody's spending money. But yeah, at least for the centralized tank batteries, one of the problems with is that you don't always know exactly how much production an individual well is producing for the centralized facilities unless you shut some of them in. So it could be an opportunity to identify what each well is producing by alternating the shut-ins across a centralized facility. So that's why I mentioned well testing. It's not like it's an expensive thing. It's just an alternating sequence of shut-ins. And then the other thing I'm curious to think about is what happens if you can put a pressure gauge on a well, and let's say you have a multi-well pad of 4 wells, and alternate the shut-ins and see what happens to the pressures, and if there's anything that can be learned from that. I don't know, but I know that some people are trying that.
Yeah, no, and I think that's definitely an interesting conversational point here for us is what opportunities come out of this, because a lot of times it's not just, so if you or your company are in the spot of, okay, let's shut it in, or curtail it or whatever, like what opportunities can we get from this? Lots of times we don't ever really take much of a break to do much of it, like pressure buildup tests or anything like that. I think there's a handful of different, like you talked about kind of with well testing, like alternating wells or figuring out production allocation, or even trying to identify, if one well is producing more water than another, and seeing if you shut that, if you'll get the rest of the depending on like how tight these wells. I mean, like you can kind of start playing with some different optimization cases while still kind of maintaining a lower overall flow rate for your field. But I get, it's definitely an interesting conversation to talk about the different opportunities like this. Anything to add on that or other ones that you've seen?
Yeah, I think in the wolf camp specifically, given that it is stacked pay, there's a really great opportunity to test a lot of, I think one thing that we don't know is exactly which formation is the water coming from, or even the oil sometimes, and are we fracking into other zones? And, I think it's a great opportunity to test that in a stacked pay, because you can, isolate variables and then try to determine, what's, where it's coming from. There's a lot of great technologies with, DNA sequencing of the oil hydrocarbons too, and pressure gauge and an alternating shut-in sequence, I think could really give you some good information on, okay, where is the production actually coming from? Is it, do we have a barrier between zones, or are we producing, from multiple zones in a single well type of thing?
Mm-hmm. Yeah, it's interesting to try and wrap your head around how interconnected or not these wells are with each other. I mean, we definitely, it's obvious whenever we, frack them, the communication there, but once they're in production, it's kind of hard to tell, and we don't really take the time or even really feel the need to know, but definitely a pretty interesting opportunity. And you mentioned, DNA sequencing. I haven't really heard of that being done, or at least with calling it that. Can you elaborate on what that is a little bit?
Yeah, I'll give a plug for these guys. It's a company called Biota, and they have applied some of the same technologies that go into human DNA sequencing and being able to look at organic materials and identify their source. And so I don't know everything about it, but I think what they are able to do is take a sample of your oil production and try to identify which formation it's coming from. So that was a technology that was being used prior to this recent oil crash. And I think it's probably a great tool to use even still, where you can, you have a chance, if you're planning to shut in, to do it in a smart way and actually get some results out of it.
Mm-hmm. Okay. Yeah. I mean, in terms of, again, kind of at that reservoir level, do we see any other potential opportunities? So you mentioned, shutting it in to let it build up, to hit the bubble point, to, again, you kind of help with that drive, depending on the reservoir. But in terms of even just kind of a reservoir data standpoint for the wells that are shut in or are being shut in, I mean, what other opportunities even on the reservoir level do you see or can you picture?
Yeah, I mean, there's probably a lot of things that I'm not thinking of that can be done, certainly. But really just ultimately trying to understand, the reservoir profile, and then what impact does a shut-in have? Maybe it's an opportunity to do a temporary shut-in, and what are the impacts of a 1 month shut-in versus a 10-month shut-in? And the timing of how long, the duration of that shut-in. What are the impacts, and what does the flush production look like? And then what can you do as far as decline curve analysis to look at if anything's changed, to see if that really is damaging the reservoir or not. If I think that would be a great test, do like a short shut in and look at the flush production for an additional, at least 1 times the time of shut in, and then, you may need a couple more months, but try to re-estimate the EUR so that you can really understand the impact, and then do that in a pilot program. If it doesn't seem to be harming the reservoir, and then apply that across that section of acreage where you think it's not damaging. But I think you have to be careful, because the geology changes pretty rapidly. It can be very heterogeneous, and so you probably be best suited to do that in a small area first, and then maybe even try that in a bunch of different areas, and do kind of a trial and see, and then maybe try a curtailment scenario where you just choke it back and see, reevaluate the estimated ultimate recoveries and see how that's impacting the field, and then then carry out those decisions forward. But we're talking about this now, and who knows what can happen in 2 months with oil prices. If we're in the 40s again, I think you could make a good case for opening wells in a lot of the plays in the Permian. But
Mm-hmm. Mm-hmm.
it'll be interesting to see.
Yeah, no, and one of the things I've heard of too is you're just taking advantage of, doing fluid level shots and try to understand, how where your fluid levels are, when you're shut in and if it's building, and like just getting a better idea for what you have to play with in a sense of how strong maybe that well actually is.
Right. And then, the other thing is if you do shut in a well, what as if you think of the subsurface and you think of the well downhole, you think of all the stages that were fracked and all the intervals, it takes some time for that well to become fully static in the subsurface too. So
Mm-hmm.
trying to identify when you're actually static in the subsurface and then when you produce again, are those competing fractures still at play, or does that change? Is there a chance for a benefit? I mean, we're really in uncharted territory, so it could go either way. I tend to subscribe to the idea that condensate gas reservoirs are a great candidate for a full shut-in. For most black oil reservoirs, for the newer vintage wells, curtailment may make more sense, but we still don't know exactly how some of these really long laterals, the 3 mile laterals, are going to react to a shut-in. And then that's the other consideration is the length of the lateral. You may need a longer shut-in time to reach a substantial pressure increase or become static. And then are the same, because we understand that a lot of the fractures that get produced can become competing and not all of them produce equally.
Mm-hmm.
But don't know, but it's certainly something that I think with all the effort and all the work and that's been done, designing a lot of these wells and putting them on production should also be done, spending some time doing diagnostics to try to understand what's happening. And if there's any wells that have fiber optics that are still functioning, those would be great test wells. And there's probably not a whole lot of them, but any wells with fiber, I would say definitely utilize those as some sort of test, utilize that information, see if the fracture productivity changes across stages over time and with longer duration shut-ins.
Oh, that's definitely interesting. Like I said, there's probably not too many of them, but that definitely you couldn't get much more clarity of data than something like that. Well, like that. You raised a good point in terms of the new wells, even too. So it's definitely a little bit of a tougher case in a sense, and I think for that one, probably mostly comes down to economics. Is it worth selling the majority of that well's production in a sense at really sucky oil prices, or to pay it off sooner, or is it better to kind of preserve that and sell it with a higher price? How does that actually look like in terms of MPV or whatever metric the company shoots for?
Yeah, I mean that's a hard one to answer. I think it's going to vary significantly across companies. It's I think a lot of the things we talked about are considerations, but at the end of the day, a lot of it comes down to what does the board want to do, and what do the investors want, and so that's going to be a driving factor too.
And what obligations they have. Yep.
Right.
That's it. Well, I guess kind of one thing that's very interesting to think about. If I think kind of we're a little bit past the initial shock. I don't think we probably shut in as much as we were kind of scared we were going to be shutting in overall as an industry, or being forced to shut in. So we might have been a little bit of a, like you said, about 20%. It sounded like potentially being shut in. Definitely less than the larger initial estimates in terms of what we'd end up shutting in. But overall, do you see any case where it might end up that whenever we go to go back to full power, in a sense, that we're in a situation now that the prices have risen to a point and we're not meeting the demands or whatever, and prices just skyrocket, and it's kind of another revolution here at the end of this? Or what's your thoughts on something like that happening?
My outlook on oil prices, your guess is as good as mine. I think a lot of it has to do more with the quality of the crude right now than and the the marketing pipeline midstream situation as well. And I think a lot of, in general, my assumption is that a lot of the major companies are more likely to be producing than shut in, and at the same token, uh, have the cash and the balance sheets to withstand the storm at lower prices for longer.
Hmm.
But a lot of the smaller companies don't have that luxury, and so that's not an answer to the oil price question, but that's more, I think, what we'll see with supply and demand, and then what is Saudi going to do, and then
Hmm.
Russia. Um, I think Saudi's still flooding the market, and they're still sending the U.S. refineries a lot of their oil, and so pay attention to the stocks at Cushing. I think that'll be, ultimately that's the price point for West Texas Intermediate, where the light sweet crude is in abundance. And so that's going to be probably a good indicator of what we can expect to see for the price of WTI, and if there's any further discounts to the price. So I would say, for the next 18 to 24 months, we're probably in a $20 to $40 per barrel range. I hope we're not down to 20 again, but I
Hmm.
wouldn't be surprised. I don't think we'll exceed $40 to $45 a barrel. I think the Saudis and the Russians, they know what our break evens are. They started this flooding of the
Yeah.
market in 2014, and they really squeezed us and watched us reduce our break even. So they're pretty aware of where that point is, and they're probably going to try to continue to squeeze the U.S. independence, which is unfortunate, but it's a geopolitical matter, and OPEC has a large part of, they're 30% of the world's oil production, so they have
Wow.
a large force, a driving force that can really impact the price. So
Hmm.
the independents, it's unfortunate the small independents of America unlocked the shale revolution. American ingenuity really came to play, and the Saudis and OPEC and Russia realized that was a threat, and so
Hmm.
they are started flooding the market, and it's been at the detriment of our great companies. But I think ultimately we'll get through it. It's going to be tough, but at the end of the day, when we look back on this, when the dust is settled, and who knows how long that'll be. I
Hmm.
think it'll be another 1 to 2 year downturn, unfortunately, probably similar to 14 through 16. The
Almost kind of felt
difference
like we never
now,
came out of that one.
yeah, you're right. We learned a lot. We definitely were able to be nimble. It was still a challenge. There's still a lot of people that
Hmm.
got out of industry. There's more people getting, those that are still, able to withstand the storm will be stronger at the end of this.
Yeah, no, for sure. And like I said, we at the beginning of this episode too, we've had a guest on where they basically did a pretty industry wide survey with a lot of executives, and nobody really at the executive level is expecting this to bounce back pretty quick. So definitely sounds like we're in it for at least a couple years to some regard. I mean, whether it's 35 or 40, maybe 45, kind of like what you were talking about. But no, I guess maybe a good way for us to kind of wrap up the discussions on this would be to kind of talk about gas wells. They're left out of the conversation a lot, just in general, like throughout this whole downturn. I think their scenario is very different. I think mostly in a good way, but I wanted to get your take on it, and I guess where you saw the differences, or just overall with the gas plays right now.
Yeah, I'm glad you mentioned that. I had a point to talk about that, and I totally forgot. But you're right. So the gas market is unique because a third of all oil production, I'm sorry, a third of all gas supply is associated with oil. So that
Mm-hmm.
20% reduction in oil wells will increase the price of natural gas, because that gas that was associated with oil is coming off the market. And a lot of it was actually being flared too. So the question of were those wells piped and able to sell that gas or not is a different story. But
Mm-hmm.
gas prices actually increase when oil prices drop.
Mm-hmm.
So that's a boon for the dry gas plays like the Marcellus, the Haynesville, Utica, and so yeah, I think that's good. I mean, I don't know I think we got down to like $1.50 on gas, and now we were up at like $3. I haven't seen what. Have you seen what the price is lately, Derek, on natural gas?
I don't follow prices too awful close, honestly. But I mean, they've been gas has been struggling for a while. They've had some low moments for sure. And I'm kind of hoping for a little mini revolution for my homeland here, back in Appalachia.
I remember you saying you went to school in Ohio. So
Yeah.
Utica, that's good for the Utica in Ohio. I think that if you were to take a long-term view, the next 10 years, there's going to be ultimately a switch to natural gas as a fuel source and a power source in general. And so I think that, what may be kind of the final countdown of shale oil in the U.S. could lead to a shale gas boom, which is the Marcellus has the biggest reserve of natural gas in the world, I think, of any shale gas place. So that's great for that's great for our country. I think we'll be able to tap into that. I'm not sure about LNG. I think there's a whole deal with, if you think about natural gas from a global perspective, Russia has a lot of it. They're sending a lot of it to Europe for power. They're working on a big pipeline there, and ultimately they control Europe's power supply. And so they could shut off those gas pipelines and Europe would be out of power. So I think where LNG was typically sending to Asia, I don't know if LNG exports are still economic at this point, but there could be an opportunity to sell to Europe from a global perspective. And I think, China will eventually, gas prices will go up to where LNG can go to Europe and Asia, because there's going to be a lot of coal to gas switching for power across the globe. In order to meet the Paris Accord and the climate change objectives, natural gas is not only a bridge fuel, it's, I think, a destination fuel for the future. So it's looking optimistic. As far as the near term, it's hard to say, but I do know that there are Jerry Jones bought a huge stake in Comstock, and they are still actively drilling in the Haynesville. And so it was funny. I watched the NFL draft, and he made his pick for the Cowboys in his yacht. Did you get to watch the NFL draft? I thought that was pretty funny.
Yeah, no, definitely. The markets kind of look different for both commodities, so it's definitely interesting to kind of keep an eye on the natural gas plays and see how they ride through all this and what their future looks like. And like you said, big picture, I think it's definitely an interesting story and a lot of opportunities there coming up. But I guess my last question for you, I think is is going to be around this. You kind of mentioned, the end of shale in a sense in terms of with the oil plays. Do you think that this might cause companies to maybe focus more on conventional assets, whether it's offshore Gulf of Mexico kind of assets, or maybe even some other areas, if somebody would ever open up the East Coast, or even just some of the kind of forgotten about, in a sense, conventional fields that shale's built up on top of. I guess kind of what's your take on that? Will we see a shift?
Yeah, I follow Spears and Associates. If you've ever heard them, they have a really good podcast called The Drill Down, and they talk a lot about the oilfield services market. And one thing they mentioned is that if there's any optimism in oilfield services, it's more related to exploration. And so I think now may not be a bad time for companies to spend less on developing or producing, but more on exploration. And a lot of that exploration, I think, will happen in the deep waters of the Gulf of Mexico and also elsewhere, offshore South America, Africa, even the South China Sea, and some of the international plays as well. So I do think that there could be a shift towards that. And then also, in the future, eventually, I think we will see more shale exploration internationally. You have the Vaca Muerta shale in South America. Even in the Saudi, they have shale plays, and I think they've tried fracking some of them. The thing that is interesting, and I always bring this up, is it's the American ingenuity that really unlocked the shale plays and ultimately like oil and gas. If you think back to John D. Rockefeller and we found oil in Saudi Arabia for them, and they didn't know how to produce it at first. And so I think as far as shale goes, there's still an opportunity even if U.S. shale has a limited life, there's going to be opportunities for shale exploration and just exploration in general, elsewhere. And I think they're going to need Americans to do that. So, they don't have the know-how and the resources to be able to do that. So I definitely think that there could be more opportunities internationally for exploration, for conventional and for shale.
Yeah, that's interesting. And keep in mind too, like, for our listeners, what you were saying, those recovery factors are just how much we're leaving behind. So there's a lot of opportunity, whenever that becomes economic, or whenever companies start focusing on that, and we've seen some kind of start to be interested in it. Obviously, it's not really probably going to be as too economical at the exact moment. But what would make the exploration case more economical than a development case?
Well, I mean, you don't have to spend as much money to fully develop a field. You may be able to just drill a single well instead of 100 wells, or and take core, or log the well, or just look at the maps. Right, you can look at maps and try to look at other companies' data, and look at opportunities to form joint ventures as well. That's a way to reduce risk. And so I think that's one, that's pretty common for exploration, is to do it under a joint venture. So, it's typically the big boys that play in that space. But that's definitely, I think, an option. I think if you think about like offshore, though, it's can be challenging, because, and a lot of what offshore development is actually exploration, because the cost to put in the infrastructure is more than the well construction costs. And so it's, cheaper to, drill a well and test it than to fully put in the facilities to produce and whatnot. But your point on the recovery factors reminded me of a good thing to bring up, is there's still opportunities for enhanced oil recovery, water floods, or injecting CO2, and to help try to improve those recovery factors. Now, granted, that's probably not going to happen in this price environment, but it's something that's been tested, and I'm hopeful that it could also kind of unlock some more of that recovery factor that's being left down hole.
Yeah, no, for sure. Well, Jon, it's definitely been a very insightful episode. I'm very glad that we finally got this going, and thank you so much for all your insight. Definitely opened my eyes to just some of the complexities of all the, and all the factors that go into this, and I hope same with my audience. So thanks again for being on. I really appreciate it.
Yeah, thanks, Derek. Thanks for having me.
Yeah, no problem. And hopefully we can get, I know we talked previously about getting some stuff on the shale field development. I definitely hope we can circle back at some point when life allows it, and use you for some of that material. You definitely have a pretty good way of educating the rest of us and teaching it. So. Yeah,
looking forward to it. Definitely. I'm going to be starting business school this fall, so I'll probably be a ghost for a little while, but as soon as I have some time, definitely going to help out there.
Yeah, for sure, man. Well, awesome. Well, best of luck to you with your MBA and everything that you have, your consulting company and everything. Really appreciate you and your time.
Yeah, thanks, Derek.
All right. Thanks, Jon, and thanks again for everybody for listening. I'll drop Jon's LinkedIn profile link in the show notes, so you can find him and track him down if you have any specific questions or want to bring him on for a project or anything with his consulting firm. You'll have a way of contacting him there. So thanks again, guys, for listening. We'll catch you next episode. Stay healthy and stay safe. We'll catch you later.